Our next guest is one of the top lenders in all of San Diego. Please welcome back to the show from Synergy One Lending, Dale Entrekin.
There he is, Mr. Entrekin, back in the house. What's up, my friend?
Not much, man. Doing great.
All right.
How about you?
Doing well. Yeah, so's the market, too.
Yeah,
A
absolutely.
lot of people wondering if that can continue, though. And I know recently you attended an event, a mastery event, sales mastery event, where the Economist Alan Nevin was there speaking. And I was just curious, what he said. Did he say anything to you that you thought would be worth sharing with everybody?
Yeah, I mean, there was a lot of great things he discussed about just the San Diego housing market. I mean, we hear so many things. So many people are, have some reservations based on the last couple of years, based on when the market collapsed, that we're kind of trending towards that again with housing prices increasing. But one of the things that he was very, very adamant about was that we're not. That he felt like we are really strong in our in just where the market's headed. That we're in a safe place. The job growth is great. Our demand is great, and he feels like we're in a good, comfortable spot.
Okay, so he was saying that don't be worried then. Things macro-wise, from an economist perspective, and these are bow tie guys, right?
Yeah.
These are the guys who study the numbers. They're looking at the past, trying to predict the future, and that's the only trouble with being an economist. But there's really no other way to do it.
Yeah.
So you kind of have to take these things with a little bit of a grain of salt. But at the same time, he didn't just say, "Oh, we've got another year," did he? I mean, he said there's
there's a long projection out. One of the things that he was talking about is that we haven't yet reached the peaks that we reached before the market crashed, right? And so the market crashed because there was bad loans. There was bad, there was interest rates were rising. We had terrible loans that were being done, stated income, bad credit, negative amortization loans, 100% financing. Those loans are all gone, right? So what's happening now is that people are buying homes and they're having to qualify and they're having to go through that process and they're having to provide documentation. And what's happening now is because rates are so good and then supply is so low that demand is up. And with the demand being up, he projected that rates are going to stay low for a significant amount of time. And if that's the case, people are still going to want to buy.
Yeah.
And they're going to keep pushing in.
Especially here.
Yeah, the population growth in San Diego County from 2010 to 14 it went up 5%. And so if you're getting that much, that many more people in the county coming in, they got to live somewhere.
That's right.
And rents are going up. So what are they going to do? They're going to look to buy.
Yeah, I think that's one of the things that's always been interesting to me about real estate is that it is sort of a population play.
Mm-hmm.
Because if the population grows, real estate values will go up. So if you believe in an increasing population, look at Detroit for the antithesis of that.
Yeah.
People scatter and real estate values go to nothing.
Yeah.
You can buy a house for $5,000.
Well, that was one of the things that he talked about is he used Detroit as an example where they were so focused singularly on one, job description. Basically, it was
one industry.
Yeah, one industry. It was the automotive industry. So when that disappeared, all the jobs disappeared. Where here, there's a lot of different avenues you can go, and one of the things that's building up now is the tech industry.
Yeah, and there's plans for that to be developed here and to really compete with Silicon Valley. It's already starting. There's over 100 companies that have committed to moving here.
See, that's amazing. What is that going to do with incomes? Incomes are going to rise from that. If that's the case, then they're going to have more ability to qualify for homes than they do today.
I tell you what I think is going to happen, and you can tell me what you think is going to happen, but I think that downtown real estate prices are going to go up a tremendous amount. This IDEA district that's going down there, IDEA 1 is being built right now, construction is happening, and I think that is going to cause the values in downtown to go up a lot, because the values in downtown are still pretty decent.
Well, yeah, especially for what we offer downtown. San Diego offers amazing, it's beautiful. I mean, there's so many things to do. There's so many places to be. I mean, and if the Chargers end up down there too, I mean, look what the Padres did with the whole community, just everything being rebuilt, all those skyscrapers and condos and everything going up that weren't there before.
Yeah, all of East Village is pretty much to thank for the Padres.
Absolutely.
So if you come down and you throw the Chargers there, that makes a whole another thing. Did he say anything about interest rates, Alan Nevin?
Well, that was the goal, or not the goal, the projection with interest rates is obviously going to be up a little bit. This summer they're going to raise rates. Again, the Fed rate's going to move, and they're going to move up a quarter probably. But that's not going to do, his words were, they're not going to do a whole lot. And that's not going to make a big difference to the market. It's going to get built in prior to that happening. When it happens, it's not going to really tip the needle either way.
You know, I wonder if we're going to get away from a relationship that has sort of always existed in the financial markets between that overnight lending rate and then the long-term interest rates like mortgages. Because they seem to be dealt with by totally different people now in totally different circumstances. Like mortgage bonds are bought by big institutions, huge funds. Whereas the overnight lending thing is pretty much just between the Fed and banks. And there isn't necessarily that overlap that it used to be where it was, the banks were the ones who were buying these and trading these mortgage notes to make money and trying to make spreads. And they're not really doing that anymore. They're pretty much just collecting the paper and shipping it off to Fannie Mae.
Yeah.
So because there's that loop is sort of closed now, I wonder if they do raise interest rates, overnight lending rate, the Fed rate, if they do raise that, I wonder if it'll even raise mortgage rates or not. If there's still an appetite for mortgage bonds and they're still being bought at the 3.5%, 4% range.
Absolutely. Well, especially if the fact is that there's still uncertainty and there's in the stock market, because right now stock market, that's where a lot of people are projecting a bubble. So where do they go for safety? They go to bonds.
Yeah.
And if that's the case, then we're going to see those rates. Even if it comes up a little bit, what are we talking about? We're not talking about a massive amount to our interest rates on a 30-year fixed mortgage or 15-year fixed mortgage. These rates are still going to stay relatively low. They might not be 3.5, but what if you're 4.25? Is it really going to be the end of the world? Is that going to bring housing prices to a collapse? No. I just don't see that rates right now are anywhere ready to go up like they were in 2006 and 7 and 8 when they started getting up in the high 6s, 7% range.
Yeah, which was a crazy time.
Yeah.
What a crazy time that was.
Absolutely.
Other thing I want to talk to you about today was Zestimates. And the reason for that is because a lot of people looking to refinance are sort of using these Zestimates, which is the Zillow estimate, call it a Zestimate. And sometimes it's close to right, sometimes it's way off. It's always hard to tell, if you're an average person, whether your Zestimate is right or not. Yeah. If it's higher than what you paid for the house, you tend to believe it. If it's less than what you paid for the house, you tend not to believe it.
It's baloney. This is trash. It just depends. It's exactly right.
Is it useful though? I mean, is it helpful for people?
It does. There's times where I'll use it. I'll pull up a property that maybe I want to see where the comps are in the area and stuff, and I want to get an idea of what the value is for a refinance. It tends to work really well when you have some great comps in the neighborhood. When there's easy comps in the neighborhood, it works well. When you have maybe more of a not super track area or a lot of homes aren't selling in your neighborhood, it might be difficult because there's communities where you might be less than a quarter mile from some other community, but the values aren't the same. So even if your square footages are similar, they're going to pull those in and it can be skewed very easily.
Okay, so without knowing how that's all done.
You have to know the areas, so that it's areas, so you can look through and kind of see it. What I like to do is look at the map where they show the little houses, show the little houses with the prices on them all through the neighborhood. Yeah. And then you can get an idea of what has sold. Because once you see what is sold on those, then you can get an idea of, okay, this is probably at this value and maybe but I've noticed that when prices are rising, it tends to lag a little bit. When prices are falling, like we had before, it was always above. So it's kind of like,
It's a lagging indicator.
Yeah,
then,
absolutely.
So it might be a little bit behind.
Yeah, because especially when things are active or pending, you have to have access to those too. And because those could flip your appraised value pretty significantly.
But ultimately, I mean, if someone is looking into it, getting the appraisal isn't a huge investment.
No.
If you're looking at saving a whole bunch of money, it's not a big deal to get the appraisal, right? I mean, that's
if you're
not. But by the time you get an appraisal, you're going to have already showed them this is how much money you're going to save. So there's not like you have to go right out and get an appraisal right away.
Absolutely. In what we try to do is we try to make the borrower understand if you're going to save this amount of money, you have to look at it as there's a little bit of a risk to take, right? And that little bit of a risk is your appraisal. And if you're going to save $200, $300, $400 a month, it's not really that big of a risk to pay to get that actual value in hand. And it's usually about around $400, $450, somewhere in there.
Yep, totally agree. Dale, thanks so much for coming in today, man. Really
Thanks,
appreciate
Derek. Appreciate it, man.
That's Dale Entrekin, Synergy One Lending and HomeLendingSanDiego.com. Stick around for more Smarter San Diego TV, where we guarantee to make you smarter than everyone else, commercial free.